everyone, happy July. We're almost done with the month here. Sorry it's taken us a little bit longer to do this video. We've been taking a little water break here at halftime. I'm Jason Jacoby here with Mark Boyer, Office founder and principal here, and we got a good one for you this month. So.
Yeah, excited to be here. I mean, we're a little bit later this month, but we're also waiting for the mid-year outlook to come out, so we want to get that to our clients and so forth. So anyway, welcome to the Boyer Brief. Good to be here together.
All right, so we got a lot to unpack here. So I'm going to ask some quick fire questions to Mark because we have a lot of information down below in this newsletter. So we're just going to do some quick fire questions and answers, and then that way you can read more in depth below. So first question, investment takeaways. Let's talk policy. Let's talk what's been going on. GDP forecast. We still thinking positive numbers here for the rest of the year.
Well, 6%, massive. I mean, really high numbers, off the charts for many, many years. Possibly this year. It's crazy. So yeah, we've been talking about that, and yes, I mean, economy's reopening. Things look very good. So yeah, I think the GDP number is going to be really big this year. But the question is that baked into the cake already?
Right.
We talked about that before. Right. But we still feel like in this cycle, there's still some upside into the markets for sure.
And leads into the next segue. So stocks, let's talk stocks. S&P is leading the indices right now. Russell was leading it at one point actually, Russell 2000 small cap index, but it's actually at the bottom of the barrel at this point. Dow and NASDAQ are hovering around 14 with S&P hovering above 16 right now. Yeah. So let's talk about what we've seen and what we're looking at going forward.
Well, you know, last couple of times we talked, growth has been lagging. It's kind of picked up a little bit in here, but we still like the value areas. Feel like diversification into large cap value is really big. Also small caps, you got to look at that. Yep. When they pull back like this, those are opportunities to buy. So we're looking for those places to add to portfolios at the small cap area. So yeah, I mean, I think there's still diversification is key. Having a little bit in all these different areas right now, I feel like that's the best way to go. But we do like the value areas too.
Okay, great. Now on the bond side, the fixed income, right? It's kind of the unflashy stepbrother in the portfolio. So let's talk about bonds, what they mean in the portfolio in this type of market, and what we expect for interest rates.
Yeah, bonds are boring. It's kind of like football, the running game. People want to see passes and exciting stuff. Bonds are your bread and butter, kind of the stability of a portfolio. You know, a month or so ago, interest rates were high, bonds were struggling. Here we are, now in July, and interest rates have actually come down, which is a positive for bonds and their price. So anyway, it's interesting, but we still think long-term over the course by the end of this year, will be high ones, almost 2% on the 10-year. So we feel like they're still going to go up. But again, we have those in a portfolio for stability, right, for the interest income. It's definitely every portfolio. There's probably some aspect, unless you're really young and aggressive, to have a bonds in your portfolio.
So let's go towards inflation. Is it transitory? Is it not? That's what's been on the news lately. Or is it a bit of both? Yeah. So what is it looking like moving forward?
Again, supply side has not been there, so that rate, supply demand raises prices. We think it is transitory in a lot of ways. So yeah, we see that mellowing out, but at the same time, we think the future is higher in inflation, especially with stimulus and things that's happening. So that's an issue. But again, looking at history, we've been low inflation. I mean, if you look over an 85-year history, inflation's run 4%. In the last number of years here, it's been 2%. Yeah. So the average over a long period of time is higher. So we'll probably see higher inflation. It doesn't mean everything goes to heck and drops off the face of the world. It just means that there's an adjustment that's made, and stocks typically over that time have been the better performer and hedge against inflation. So
good to know.
We got to remember that.
Okay. Real quick, let's touch on international markets. The weakening dollar, or so we thought, right? We thought the value of the dollar is going to go down, strengthening a little bit. But again, over the next 6 to 12 months, are we going to see that dollar weaken? Talk about international, how that ties in together.
I think it's in the higher range now. It's come back up. Again, international, we have liked it, and it's kind of hasn't been really exciting recently, but still feel like longer term that international piece, especially in the large cap area, has some real potential as Europe, Japan, some of these areas kind of come out of COVID. They're still dealing with issues, but that's going to finally, like the U.S., start to open up, and you want to be ahead of the game there. Yep. So that's what we're going to try to be still with the international piece.
and then that ties in with the value of the dollar, right? If it weakens, then when we're converting from foreign currency to US, it actually can help enhance returns possibly, right?
So stronger dollar hurts international investing, weaker dollar helps it. So as a hedge against people's concern in regards to the dollar, if we feel like it's going lower, another reason to be in the international space.
Good to know. Good to know. All right, so final piece we're going to cover here in the video, corporate taxes. Okay, so a lot of fear, a lot of worry talking about corporate tax increases, which is obviously passed along to the consumer. Less corporate profits, which means markets might have some headwinds at this point. But history doesn't always say that. So, you know, Biden's coming out with a 28%, you know, ask, but I think that could be a negotiation tool. Us and our LPL analysts think around 25% they're going to settle out, which is the second lowest in the last 70 years. So still higher, which obviously we don't like, but again, if we can settle still second lowest in history, you know, what does that mean? Like, you know, you have a lot of experience in this industry. You've seen the corporate tax hikes in the past. Markets tend to sometimes do well over the next 6 to 12 months after.
I mean, so none of us like paying taxes. I mean, it's like, you know, inevitable death in taxes, right? We all dislike that. And markets in surprises to taxes can react in a decline, and they may not like it or whatever. But bottom line is, you know, cap gain taxes have been much higher than they are today. They're talking 30, 40%. There's been times where they've been high and the markets have done well. So, you know, it's it'll work itself out. We'll see how it goes. You know, I'm going to hold on to my money as much as possible. But the reality is we'll just have to wait and see. And you know, I don't think it's a major factor long term. Just again, you got to stick to your plans. There's a lot of things. Remember, there's always a lot of things to worry about in investing. There's a lot of things to worry about. But again, typically the long-term investor who hangs in there in a diversified, solid, well-diversified portfolio does better than those who let, again, their minds go and get really emotional in the market. So again, stick to it. Work with us, talk to us if you're concerned or if anything. We're here to help. It's our job. It's halftime, and we can make adjustments. And we're talking to some of our managers about that right now. Because it is halftime, it's kind of mid-year, and so we're looking to see in the second half where the best opportunities are.
Absolutely. You heard the wisdom here from the man himself, Mark Boyer. And I'm Jason Jacoby. We're Boyer Financial, and we'll see you next month. Have a good one.
Take care.